This is Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. Welcome to the weekly Top 3, the top 3 things on our mind here at Alaskans for Sustainable Budgets for the week of July 13th, 2026. The weekly Top 3 is a regular segment on The Michael Dukes Show. The show broadcasts on both Facebook Live and YouTube Live, as well as via streaming audio from the show's website weekdays from 6 to 8 a.m. I join Michael weekly in the first hour of Tuesday's show from 6:10 to 7 a.m. for a discussion between the two of us about our 3 issues. We post the podcasts of our discussion following the show on the Alaskans for Sustainable Budgets Facebook, YouTube, SoundCloud, Spotify, and Substack pages, also on the Alaskans for Sustainable Budgets website, as well as the project's page on national blog site, medium.com. You can find past episodes of the weekly Top 3 also at the same locations. Keep in mind that in addition to these podcasts, during the week, you can also follow and participate in the discussion with us of these and other issues affecting Alaska's fiscal and economic condition by following us on the Alaskans for Sustainable Budgets Facebook page and through our posts on Twitter. This week, our top 3 issues are these. First, we update our look at the performance of the Permanent Fund Corporation for the information contained in its most recent performance report. Second, we explain how the state is making the economic situation faced by middle-income Alaska families even worse than that caused by the other disruptions in the economy. And third, we explain why the response of some to the proposed S-corp fix, we will get to that, is so disingenuous. And now, let's join Michael.
Brad, we got a whole metric poop ton of stuff to cover today, and I know that you've got you're hot and heavy on a few of these things. So I want to get started. First and foremost, I want to talk a little bit about the weekly top 3. We're going to start off with the Permanent Fund and returns from the Permanent Fund. And before we jump into it, I just want to say congratulations, because your and my discussion on this topic seems to have moved the needle on at least a couple of the candidates for governor, that they're at least picking up a couple of your talking points and at least looking at it. Brad's going to cover the update on the Permanent Fund returns here for number 1, but at least I know that Bronson and Wilson have both talked about it now as a potential thing that they need to be dealing with when they become governor. So congratulations on that, at least, I guess.
Well, thank you. So I've got, you've never seen my studio. The listeners have never seen my studio, but I always have in front of me prompt notes. And usually it's a whole set of prompt notes that go on about the 3 subjects and all that sort of stuff. I've got one prompt note today. It's $1.9 billion deficit. That's the one prompt note for everything that's coming up today.
You're a one-trick pony, Brad. That's what it is.
For today, and maybe most days, but for today I am. And it is all 3 subjects today. When we had the discussion yesterday about potentially substituting in one end, all 3 subjects today are all focused on the $1.9 billion deficit. And we're going to start with permanent fund returns, which is one place that we can generate, that we should be generating additional revenues. I want to show you something. I do a chart every month when the Permanent Fund Corporation comes out with their returns. And I want to show you something on this chart. This chart compares the permanent funds returns, what they say they are earning, to the S&P 500. I'm not going to focus as much on that today, but to 3 other performance benchmarks. One is the total fund return objective, which is CPI plus 5, which they say is what their objective is. But they have 2 other benchmarks, a performance benchmark, which measures whether they are living up to the performance standards, that whether the investments they have are living up to the performance standards that they've set. The third is the one I'm going to focus on, the passive index benchmark. And as I understand that benchmark, it is a benchmark that says, what if we didn't have people in this building? What if we just set our return, our investments into ETFs, exchange traded funds, and let them work? I mean, we would set what the parameters are. We would say it's either going to be 60% equities or 70% equities or 50% equities. And then we're going to have other indices for the other percentage, a bond for a portion of it, private equity. There are traded funds that sort of match private equity for another portion of it. Whatever. We're going to we'll set the percentages, and then we'll just walk away and let the exchange traded funds operate. Now, instead of the exchange trade, instead of the passive index, passive investments, what they're doing is they're actively managing the fund. We talk about this from time to time about how much it's costing. It's now running about $1 billion a year to actively manage the fund. So in order to generate whatever returns they're generating, they're spending about $1 billion in investment a year, as opposed to what would happen under the passive index benchmark, which would be sort of set it and forget it, and come back and check it every once in a while, make sure it's operating the way it's supposed to be operating, but not spend $1 billion a year in picking out individual investments that they're gonna follow. Let's look at the results, and I want to focus on the permanent funds returns versus the passive index benchmark. And I want to focus on the bottom four rows. The first row, the one in yellow, is the FY26 year-to-date average. We won't get the final. That's an 11 month over the 11 months of FY26 that they reported on. We won't get the final one for another month or so, but that is the year-to-date average. And then below that, below the gray area, the gray bar that says PFC rolling average periods, they've got a rolling 5-year average, a rolling 3-year average, and a rolling 1-year average, which are 12 months, 36 months, and 60 months of results. I want to compare the permanent fund returns against the passive index benchmark, the set it and forget it benchmark, as opposed to the spend $1 billion a year. Look at the 1-year average. Let's just start by looking at the 1-year average, the bottom row. On a rolling 12-month average, the permanent funds earn 14%. So everybody goes, yay, 14%, after spending $1 billion to get to that 14%. Look at what the passive index benchmark, and I'm not doing these numbers. These are the Permanent Fund Corporation's own numbers.
Right.
Look at what the passive index benchmark is for the past 12-month average. 20.51, 6% above where the permanent fund itself has gotten by spending $1 billion a year. Look at the 3-year average, 10.52% for the permanent fund after spending $1 billion a year. Look at the passive index benchmark, 15.33%, 5% higher than what the permanent fund has earned after spending $1 billion a year. To get to 10.52%. 5-year average, 6.7% for the permanent fund, 6.68, very slightly lower for the 5-year average. But look at what's going on with FY26, 11.94% for the permanent fund year to date, FY26, 11.94% permanent fund. 16.69% for the passive index benchmark, the set it and forget it passive index benchmark. So it's not going to take maybe next month, maybe the month after that, but at that rate, at that difference, the 5-year average is quickly going to roll over and be higher for the passive index benchmark than it is for the permanent fund. We're spending $1 billion a year to get significantly lower returns out of the permanent fund than what the passive index benchmark would be. Now, I mean, we can compare it to the S&P 500, which I do often, and which we should, to sort of figure out what's going on in terms of the returns, and look at the S&P 500 over the last year, 3 years, 5 years, year to date. Over the last 1 year, the S&P 500 has been, on the rolling 1-year average, it's 29.91 to 14, more than double than what the permanent fund is returning. On the 3-year average, it's 21.6 for the S&P 500 versus 10.52, more than double what the permanent fund's producing. On the 5-year average, it's 14.10 versus 6.7, more than double what the permanent fund is generating after spending $1 billion. Look at FY26 to date. S&P 500 23.53, FY permanent fund 11.94, more than double what the permanent fund's generating. It is ridiculous what is going on over at the permanent fund. You want to talk about a bureaucracy? We've got $1 billion bureaucracy over there that can't even hit its own passive index benchmark. And so when we talk about the $1.9 billion annual deficit, where are we? How are we ever going to close that? Oh my gosh, we got to cut spending by 25%. No, you don't. And you can't. I mean, Dunleavy couldn't do it in 2019, couldn't even get close. And he wasn't even trying to hit 25% spending cuts. You need to look at the revenue side, folks. And you need to understand what's going on the revenue side. We are leaving our permanent fund corporation with its stellar, outstanding board members, all of whom are upstanding citizens in the community, none of whom know anything about investments, but all of whom are upstanding under as unstanding, stellar board members. They are producing less than double, less than half, of what the Vanguard 500 is doing. They can't even keep up with their own passive index benchmark. So one of the places when we talk about the $1.9 billion deficit that we need to go,
right?
One of the places is we need to go to the permanent fund corporation. Flip that other chart up just for a second, because I want to show how this translates into. And we've talked about this chart before. This chart compares the level of the permanent fund in red over time compared to what it would be if we'd invested in the S&P 500 over the same period. We're taking the permanent fund is reduced by dividends, obviously, and reduced by expenses. The S&P 500 is reduced by the dividends that would be generated at those levels, at those permanent fund corporation earning levels by investing in the S&P 500. So it's apples to apples. It's not reduced significantly by expenses, because we wouldn't have any expenses if we use the exchange traded fund, the electronic traded fund. Look at what the gap is. And this is just since 2019. Look at what the gap is that's developed in what the level of the permanent fund would be between what it is now investing and how it's investing at $1 billion a year versus what it would be if we would have invested in the S&P 500. $60 billion, $70 billion difference between the two. That is, you can see in the red and blue bars that are at the bottom, you can see the difference in the earnings that's generating over time. The blue, and having invested in the S&P 500 would be generating significantly higher earnings than what the permanent fund is doing. Okay, people don't like the S&P 500. Fine, let's use their own passive index benchmark. That would be somewhere in between those two bars, and it would still be significantly higher than where the permanent fund corporation's getting after spending $1 billion a year in expenses to produce deficient returns. So when you want to talk about closing the $1.9 billion gap, this is one place we need to be looking.
Right. And for those of you who are on the radio who can't see the chart, of course, you can always view the charts here on the Facebook page or wherever. But Brad showing at the end here, fiscal year 26, the difference if we had left it on the S&P 500, the balance of the permanent fund would be about $158 billion versus the projected $91 billion that we're getting right now. So almost a $70 billion difference by the time it's all said and done. And that's just from 2019. If we started off even Stevens at 2019, there are more volatile things. I mean, it is a little more volatile, but it always trends upwards in the long run. Why are we spending $1 billion a year to make less money? That's the question, right, Brad?
Absolutely, Michael. That is absolutely the question. I mean, people complain about government bureaucracies. The Permanent Fund Corporation is one big, huge government bureaucracy. Not only the employees the number of employees they have, but the expenditures they're making outside the management fees and other things that they're spending outside to maintain the investments they have, the investment program they have. I mean, I'm sure I'm going to hear about this, and I'm sure there's going to be all sorts of excuses, and I'm sure I'm going to hear about how safe they are and how reasonable they are, and how these investments are all good. But look at your own passive index benchmark. Look at the thing you publish that says if we went on autopilot, this is what we would return. 6 point percentage points higher on a 1 year. 5 point percentage higher on a 3 year average, and it will soon be higher on a 5 year average.
I just want to point this out. On this chart. Whoops, wrong one. Let me go. Nope, this one right here. They may say, well, it's more volatile. The Vanguard, it's more volatile. And sure, if you look up here in fiscal year 22, you could see in fiscal year 22, the permanent fund, the drop on what they were doing was only 1%. And it went down a whole 10% with the Vanguard. So there's a 9-point difference. But look around it. The year before, again, 12 points difference. The year after, a 14-point difference. The year after that, a 18-point difference. I mean, sure, it's more volatile in the down times, but it always recovers faster. It always ends up being better in the long run when it's all said and done. Brad?
Well, no, that's exactly right, Michael. I mean, they go back to the meltdown, the market meltdown in the 2000 period, the late 1990s and the early 2000s, and then the market meltdown in 2008, and say, oh my gosh, look at how poorly the S&P 500 did. Well, it did. You're right. But we're now 25 years from the market meltdown in the late 1990s, and we're now 17 years away from the market meltdown in 2008. If you look at this chart, if you look at compare the Vanguard to the permanent fund, I think this is right. Let me go through it real quick. I think in every year except one since 2012. Since we got through the market meltdown of 2018, everyone since 2012, yep, the Vanguard 500 has exceeded the permanent fund. The 1 year it didn't is the one you pointed out, 2022, when we had a brief market meltdown, but then it popped right back up. And if you look at the average over time, if you look at the 10-year average, and I could even do it looking at the 20-year average, the S&P 500 is exceeding the permanent fund. Now, the people will say, oh, no, we can't use the S&P 500. That's too dangerous. It's too risky. Fine. Look at the passive index benchmark instead then. I mean, they are admitting, their own benchmark is admitting that they aren't keeping up with the times by spending $1 billion a year. So these are fine people on the board, but none of them know what they're doing. I mean, none of them are any great shakes as investors. They're not known for being investors. They're not known for, having the green eye shades and understanding numbers day in and day out. They're nice people. I love nice people. They ought to be on the ADA board. They ought to understand. I mean, they ought to be focused on what, how we spend state money through ADA to develop the state. They would understand that. They should not be on the permanent fund board, and the permanent fund board should not be doing the type of investments they are.
Yeah. Yep. No, it's astonishing to me that here we sit, even again, their passive benchmark supposed to be 16.9%, 16.69%, and we're at 11.9. The 10-year average is we're barely making the 10-year average, but almost every other year you look at it and they're not even hitting what their passive benchmark should be, let alone the S&P 500. S&P 500 is worlds ahead on that, the Vanguard and S&P. So anyway, like I said, we're making some noise here and somebody's figuring it out, but it's hard to get them to move the needle on this. 50 seconds.
Well, if we didn't have a $1.9 billion deficit, this might be a nice esoteric discussion. But we've got a $1.9 billion deficit, and we ought to be looking under every rock to find the ways to close that.
Yeah, no, absolutely. Anything we can do to do it. Charlie said, are Brad's numbers net of fees for both examples? I don't know. Are they net of fees for both examples? He says they pays.
There aren't fees with the S&P 500. There aren't fees with a passive index. You're using like exchange traded funds.
Right. Okay. Brad Keithley, Alaskans for Sustainable Budgets. We continue on now with the weekly top three, where Brad says middle income Alaska families are struggling and the state government is just making it worse. Talk to me here, Brad. What's going on?
So there's all sorts of headlines that I can pick from this week's news to talk about the impact of the current economy on middle income families. One in the Alaska Beacon, urban Alaska's high cost of living, driven by healthcare and groceries. Fairbanks News Miner, energy apparel costs spike. Alaska Beacon, out-migration, inflation, school choice. Alaska school closures continue, like Alaska school closures likely to continue without changes, blaming it in part on out-migration, which is in inflation, which is being driven by the economy. I did some charts, and so the question is, what are we doing? What is the state doing to help middle income Alaska families? Let's forget lower income. Let's forget upper income. What is the state doing to deal with this? To deal with the situation with middle income Alaska families? And that's 60. That's the 60% in the middle. If you do it by quintiles, it's the upper middle, the middle, and the lower middle. Let's focus on the 60%. What's the state doing to help them? And the answer is, I mean, if you had a politician on here, they'd say, oh, we spent on childcare, we spent on schools, we spent on this, we spent on that. We took money and we directed it to try to help middle income Alaska families. Well, let's talk about where you got that money. And let's talk about how that's affecting middle income Alaska families. Two charts I did on last Friday's column that really were eye openers to me. Frankly, I hadn't put the numbers in this way before, and I decided to do it for the Friday column. So you can go back and see it in the Friday column. Here's the first one. The first one is the 5 largest sources of state tax revenue. And I just did the top 5. The first is the PFD tax, or the PFD cuts, the largest source of state revenue, of tax revenue. Second is the production tax. The third is the non-petroleum corporate income tax. The fourth is the petroleum corporate income tax, and the fifth is the petroleum property tax. Those are the 5 largest sources of revenue, tax revenue, into the state. So let's compare them. And what I did was go by year from 2017, the first year of PFD cuts, the first year we instituted the PFD tax, to 2026, estimated on 2026. And I looked at the level of tax that was collected through these various sources across this time. The average for the 10-year period from 2017 to 2026, the average was annual average over that period. We collected more than $1 billion a year, $1.066 billion a year. Rounded, that's $1.1 billion a year through PFD cuts. Through production taxes, 754, and then through the other 3 of the largest sources of tax revenue in the state, the largest sources of tax contribution toward closing the deficit in the state. They're all less than $300 million. In fact, they're significantly less than $300 million. When you look at them, they're sort of minor buzz. When you add them and the production tax, the average production tax, you barely get to the same level that what we're raising through PFD taxes. And so the biggest source of revenue that the state is using to close the $1.9 billion is to take money out of middle-income Alaska families. Is to take more money out of middle-income Alaska families than any other way of raising revenue would affect them.
And then give it back and tell you what a great job they're doing trying to take care of you after they've taken all the money, and then they're giving it back.
Give it back to some of you.
Right.
Give it back to some of them. What they're doing is they're discriminating. I mean, We see it in the economy all the time. Price discrimination. I'm going to charge you more for this car than I'm going to charge that guy for this car. I'm going to charge you more in Alaska than I'm going to charge you in Washington State. They're price discriminating or revenue or spending discriminating by giving it to select groups. And then when you campaign, you try to stack up the groups that you favored to get enough votes to beat the other guy. That's what's going on in this state. We're spending for dollars, we're spending for votes, and we're spending for special interest groups that will stack up behind me and reelect me. And where are we getting the money? We're pulling it out of the very people that we are just saying, oh no, they're in such poor shape. Middle income Alaska families, such poor shape. The next chart really stunned me. This is if you look at PFD cuts as a percent of adjusted gross income in the state, what it would be viewed as an average tax on adjusted gross income. And so average, we're in the middle income bracket somewhere. It's not the median, which is different from the mean, from the average, but we're somewhere in the range. This is the tax rate that's falling on the income of the middle income Alaska families as we go along by using PFD cuts. So it's 2.76% in the far left on the far left side in 2017. Then it goes down a little bit as the level of PFD cuts go down, as adjusted gross income is climbing somewhat, and then the level of PFD cuts start climbing, and so do the level of the tax rates over the period. The last low tax rate was 2.61% in 2023. Since then, 2024, 2025, 2026, 2027, the tax rates have exceeded nearly exceeded 4%. There's 1 year in which it's 3.93%. But look at what's been going on from tax rates that were on middle income Alaska families. These are the average tax rates, so they're somewhere in the range of what's hitting middle income Alaska families. From tax rates that were 2.76% on middle income Alaska families up to 3.96% over the last 5 years, we've had tax rates of 5.26%, 3.93% because the level of the PFD cut went down a little bit, 4.72% in 2026, and then the all-time high, both in terms of the level of the PFD cut and in terms of the tax rate, is this last legislature, the one that isn't gone yet because they're still in conference committee, but this last legislature, when they finally did the FY27 budget, this last legislature, the tax cut is $1.957 billion, nearly $2 billion. The tax rate falling on middle income Alaska families is 5.4%. From 2023, just from 2023 to 2027, the tax rate has gone from 2.61% to 5.4%, more than doubled. Maybe that's the theme of this segment, doubling, more than doubled from 2023 to 2027. The average tax rate over the period is 3.63%. That is the average tax rate that we have hit middle income Alaska families with by using PFD cuts as the primary revenue source, tax revenue source. Not only the primary tax revenue source, nearly half of total tax revenues from the top 5 tax sources have come from PFD cuts, targeted taxes that hit middle income families hardest of all of the options that you could do, all the alternatives out there.
Right.
That hit middle income Alaska families hardest. One other thing about this chart, I included on the chart just to pick up what we were talking about at the beginning of the session when Governor Dunleavy proposed the sales tax. I've picked up what the impact would be if instead of using PFD cuts, we'd used a broad-based tax, and through the use of a broad-based tax, picked up a portion of the revenue from non-residents, like happens in the other 49 states plus the District of Columbia. Alaska is the only one that's not picking up revenue from non-residents. If we had done that, using the ICER numbers from the beginning of the session. If we'd done that, the 3.93 average tax rate, 3.63 average tax rate would be about 3.1, I think is the right number. Yep, there it is. Well, it's 3.1, I think. So about a half percentage point different between the two approaches. Using PFD cuts only affect Alaska families. Using a broad-based tax that included non-residents would reduce the impact on Alaska families by about a 0.5%. So
right.
This is, I mean, when we talk about middle-income Alaska families, we've got to. This is how we're closing the $1.9 billion deficit. We're taking it out of the pockets through exceedingly high tax rates. We're taking it out of the pockets of middle-income Alaska families. And then we complain about, oh my gosh, middle-income Alaska families, they're not doing very well, are they? The economy isn't doing very well for them. Well, yeah, and the state's making it worse.
Right. Well, and as you said, if the middle income Alaska, the average is 3.6%, and if we were doing a broad-based sales tax, it would be 3.1%. That doesn't sound like a lot to people. It is a 0.5 percentage point drop in the middle incomes, but what you don't see is it also is a tremendous decrease for the lower incomes, because some of them are at 20 and maybe 30%. So they go from that to 3%. And it's also an increase on the upper incomes because they go from 0.8% or 0.5% to 3.1%. So again, it equals everything out in the end. But this is where it is. The problem is that people, including Randy, are not seeing this as a tax. They don't see you're already being taxed. 5.4% next year in the middle income brackets. You're already being taxed. Average family of four is losing $11,000 a year on this already. They're just not seeing it.
Yeah, well, it is. I mean, I don't know how it can be any clearer. It is revenue that otherwise would end up in the pockets of Alaska families that is being withheld by the government and diverted to government spending. That is the very definition of a tax. The only reason you don't think it's a tax is because it doesn't come into your pocket. Actually, withholding taxes don't come into your pocket either. They're withheld by your employer and diverted to the government. This is simply another form of withholding tax. The only reason we don't call it the only reason that people don't think it's a tax is because we call it PFD cuts instead of a tax. Just like we call tariffs instead of a tax. Oh, it's not a tax because we don't call it a tax. We call it a tariff. So it's something different. Well, PFD cuts are taxes. Right. We call them something different, but they're taxes. It's the withholding and diversion to government of revenue.
I'm going to disagree with something that Chris just said. He said liberal minds are the only ones seeing it as a tax. And I'm sorry, Chris, you're wrong. There's tons of Republicans out there who are like, well, I don't care. Take my PFD. It doesn't hurt me. It's a tax. Are you kidding me? Again, even ICER said that if you replace the PFD take with a broad-based sales tax, seasonal sales tax, the average Alaskan would have 30% more money in their pocket at the end of the year. I mean, come on, man. And it's not just the liberals who are missing it. There's tons of Republicans, dyed-in-the-wool conservatives out there who I know, who are friends of mine, who disagree with me on this, who say, oh, well, we don't need that PF. It's a tax, dude. It has the effect of a tax. If it smells like a tax and it walks like a tax and it quacks like a tax, it's a duck tax. That's what it is.
Michael, and maybe it helps some to explain it this way. PFDs are the Alaska equivalent of oil royalties. When my property in Oklahoma or my property in Texas generated revenues, oil revenues, or generated oil, I got a share of that as an oil royalty, as an owner of the resource, as an owner of the mineral estate and an owner of the resource. I got a share of that. All we are, and nobody thinks about that, is free money. It is. I mean, I had clients when I was back in Oklahoma who didn't know they had oil on the land. All of a sudden they discovered oil. They hadn't paid for the oil. They hadn't paid for oil. They bought the land as farmland, but all of a sudden it had oil under it. And so, it's nobody said, oh, it's free money to you, so the government's going to take it. And it's not really a tax when the government takes free money. It is taxing PFDs is the same as targeting a tax on oil royalties in the lower 48. Alaskans are common owners of the resource. We have one big family trust. I used to deal with family trusts in the lower 48. They would own the oil as a family. They would own it as a common resource. Everybody get a share of it. Well, Alaska is one big family trust that owns the commonly owned resource. And what's happening is the oil royalties are going into an investment trust, just like happens with a family trust in the lower 48. And the revenues from that are in the lower 48 are being distributed to the family. That's what's happening in Alaska. And when you start to think about what that revenue really is, it's not free money. It's not government largesse. It is the benefits of common ownership, the benefits of ownership of the resource. When you think about that money that way, the government withholding and diverting it is in fact a tax. Yeah, and that's exactly what's going on.
Brad, I wanted to touch base on this NSTAR thing. We got less than 3 minutes. If you could just give me a brief summation. I know we're going to dive into it a little deeper next week, but this RCA decision that submarines the storage thing for NSTAR, I got wound up about it yesterday. Maybe I'm wrong. What's your hot take on this quickly here?
What's going on is both NSTAR and the RCA are struggling to figure out how to deal with the situation we're in with the Cook Inlet declines. NSTAR wants to do more storage because and generally it's a good idea to do more storage, because when you're going to go to LNG, or when you're buying cheap gas in the summer from fields that you can't count on, full time, you want to store it someplace and then have it available when you hit winter. And NSTAR wants to do that. That's a good thing to do. The problem with this latest decision is NSTAR really didn't have a fully formed idea of what they were doing. They had an idea of they wanted to store gas in this field. They wanted storage rights in this field, and they knew who they were going to buy them from. But the problem is there's a dispute going on about who really owns that field and who really owns the pore space and the storage rights between Hillcorp and the owner that NSTAR wanted to buy it from. The DNR is dealing with that. They haven't decided it yet. NSTAR, for its part, really didn't know how much it was going to spend on that. And what they were asking the RCA for was advance approval of a concept of buying this resource if they could buy it, of buying this space and storing in it, putting in the kit necessary to store it. But they wanted RCA advance approval before they really had a fully formed idea. So what the RCA said was, you can't tell us enough about this project because you haven't fully formed it yet. And so we're going to reject your request for advance approval. That is the approval to put whatever you spend on it in rates. We're going to reject your proposal for advance approval because it's really not a fully formed idea.
Okay. All right. I mean, I guess that's a little bit better than what I was envisioning, because again, I was looking at this and just thinking, man, what are we gonna do? It's gonna be a tough thing for sure. Brad Keithley, Alaskans for Sustainable Budgets. The weekly top three. We're on to number 3. It's always the fastest hour in radio, and this is what he likes to call the obligatory S-corp discussion. The obligatory S-corp discussion. All right, Brad. Some say that they're going to get to that in the future sessions, that it doesn't need to be talked about now. You say you don't think that's going to happen.
All right, here we go again. $1.9 billion deficit. Everything we can do to close that deficit and reduce the burden on middle-income Alaskan families, who we say are in trouble, and they are, in fact, in economic trouble. Everything we can do to reduce that burden on middle-income Alaska families, reduce the 5+% tax rate we've got on them, we ought to be doing. We ought to be having increased revenues from the Permanent Fund Corporation by a better investment strategy. We ought to be looking at other alternative revenue sources, such as a sales tax, which spreads the burden broadly and reduces the burden on Alaska families by shifting a portion of it to non-residents, as happens in every other one of the 49 states plus the District of Columbia. We ought to be doing that. And we ought to be looking at the S-corp fix, because that would help produce additional revenues, fair revenues, additional revenues to help relieve the burden that is currently existing as a result of PFD cuts. One of the earliest lessons I learned in politics, I still remember it. I remember the meeting. I remember how I went into that meeting. I remember what was said during the meeting. It's just as clear today as it was at the time. And I was in my 20s then. I'm not in my 20s anymore. One of the earliest lessons I learned in politics was as a result of a meeting I went into with a congressman in the late 1980s when we were talking about fixes to the Natural Gas Policy Act, which had created distortions between what's called the interstate market and the intrastate market. Went into a meeting with a congressman to talk about fixes to the Natural Gas Policy Act. And the congressman said the following. He said, "We'll get to that. That's important. I understand what you're saying. It's an issue we need to deal with. We'll get to that. But we got this one other issue we need to deal with first. And I've got a bill up that deals with that issue. And to keep it clean and to get it through Congress, I need to keep it focused on. We'll get to your issue. Don't worry about it. It's an important issue. I understand what you're saying. I understand all the charts you brought in. I understand all the legal arguments you brought in. We'll get to that issue. Don't worry about it." What happened? They passed the bill. They never came back to the issue. They never came back to my issue. The issue my client and a lot of other clients were talking about with the congressman. And later asked the congressman, "What happened?" "Well, we just didn't get back to that. I'm sorry. I know it's important, but we just didn't get back to that." That lesson still sticks in my mind today. If there is an issue and if it's timely and ripe to deal with it. Don't say, "I'll get to it tomorrow," or "I'll get to the next legislature," or "That's an important issue. We ought to talk about it more. And we ought to, really spend a lot of time on that, and we'll get to it down the road." Don't buy that. That's the S-corp issue. The S-corp issue is a fair issue. All we're doing is extending the same petroleum corporate income tax that we've got currently applicable to Conoco, who's investing and growing, to Santos and Repsol, who are investing and growing, to Exxon, who's still investing. All we're doing is extending the same corporate income tax that we've got to them to Hillcorp. The only reason it's an issue is because Hillcorp is organized for federal income tax purposes. Has really nothing to do with the state. For federal income tax purposes, Hillcorp's organized differently. But all we're doing with the S-corp fix, the loophole fix, is extending the same corporate income tax that we've got with Conoco, Repsol, Santos, and the others. All we're doing is extending that to them. And when people say, and to Glenfarne also, so it's relevant to the bill. We're telling Glenfarne what the rules are going to be once they generate income 15 years from now, or generate income 15 years, taxable income 15 years from now. We're telling them what the rules are. All we're trying to do is get that fix done. And people who say in op-eds or in arguments or on Facebook or on Twitter or wherever they say it, people who say, "Don't worry, we'll get to that. It's an important issue. We'll talk about it." Every time they say that, every time that word comes out, those words come out of their mouth, I'm thinking of that congressman in the late 1980s who did that to me.
Right. And you made a valid point. I don't remember where you made it, if you made it here on X or wherever you made it, but you said Hillcorp is already dealing with this in Texas, where they're organized as an LLC, right? Or S-corp, and they're already dealing with that down there. They have to pay the taxes down there. They're just not paying any taxes up here. It's the same thing, right? So they're still paying down there what they would be paying up here if we had a different tax structure. So it's not that far a stretch. Is that what you're saying?
Yeah, exactly right. I mean, Hillcorp's dealing with it in, I would think, every other state they have. Every other state, I mean, I know Louisiana, Oklahoma, Texas, New Mexico. Those states, those states get at it either through, in Texas, through the business franchise tax, which doesn't have an S-corp loophole. If you're a corporation, whatever kind of corporation you are, you pay the business franchise tax. Or in Louisiana, Oklahoma, and Texas, they mimic the federal system, which is we don't tax you at the corporate level. We let it drop, but we tax you at the personal level. Louisiana has a personal income tax. Texas has or Oklahoma has a personal income tax. New Mexico has a personal income tax. We tax you at the personal level. Those states have taxes on Hillcorp and on the Hillcorp proceeds. Alaska, of those states, of those 5 states, Alaska is the only state that's not taxing it at all. We aren't taxing it at the corporate level like Texas does. We aren't taxing it at the personal level like Louisiana, Oklahoma, and New Mexico do. It's just dropping tax-free through the system. And, and if we didn't have a $1.9 billion deficit, tax-free be fine. Heck yeah. Everybody ought to be tax-free. Right. We don't have a deficit. Shit. Yeah, let's keep going. But we have a $1.9 billion deficit, and we're pushing it off on middle-income Alaska families exclusively by using PFD cuts, taxing them at the rate of 5%. We're pushing it off on middle-income Alaska families because we have a $1.9 billion deficit. We ought to be finding reasonable ways, expanding the base to include non-residents, getting the permanent fund corporation to earn what it should be earning, and including other companies in taxes like we include Conoco, in corporate income taxes like we include Conoco, Repsol, Santos, and the others. We ought to be doing that. And when somebody and this bill is the perfect time to do it. And somebody telling me, no, we'll get to it. Don't worry about it. We'll get to it. It's important. Yeah, that just does not resonate. In fact, it gets me riled a little bit because I remember having gone through that with the congressman.
Right. Well, what do you think happens, Brad? We got about a minute here. What do you think happens? Conference committee, they're supposed to vote in 2 days. They're down there. Latest article up this morning in the ADN said they've gotten nowhere. In fact, they were gone. They didn't come back until yesterday. They've been gone for an entire week and a half, 10 days. What happens here? 45 seconds.
I'm confident what they've been doing, that the staff's been doing, is they've been trying to fix all of the various little nits that people brought out about the S-corp tax, about we don't have a form and all that sort of stuff. They're having staff fix all the nits, and so the nits are no longer an issue. So you can come back clean and say, okay, we fixed all the nits, we fixed all this other stuff you were complaining about. The issue is an S-corp tax versus not having an S-corp tax, and we're going to have an S-corp tax. We fixed all the nits. Forget about that; those are done. And I think that's what the meantime has been, to fix all the nits.
I don't know, Brad. I feel your pain. And I look at this, and I'll just be honest with you. I mean, I have no hope that the legislature is going to do the right thing. So do you think, because they're talking about how, well, the Senate, they won't, you can't amend it on the floor. It's an up or down vote. So they're just going to, so what do you think? They're going to squeeze the S-corp thing in there to try and get it through to get the Senate's vote? Or are they going to try and hold it back? What do you think is going to happen?
No, I'm pretty sure the S-corp provision is going to be in there.
Yeah.
And I mean, if you just look at the conference committee members, I'm pretty sure the S-corp provision is going to be in
there. Well,
then
what's going to happen? What happens with Dunleavy then? Because he's already said, and he was quoted in so it's going to be tough. It's going to be tough.
Well, Mike, be tough. I mean, sign the bill. Let's get on with the gas line. Let's fix the S-corp loophole. Let's stop putting it off. To the next thing, to the next thing, to the next thing. Let's fix the S-corp loophole, and let's get on with life, as opposed to fighting about the S-corp bill until the cows come home. If Dunleavy, if the S-corp provision's in there and it's clean, it should be after they've had enough time. If the S-corp provision's in there, but they nevertheless approve the property tax adjustments that the governor's argued for, and they nevertheless clean up the other stuff the governor's been upset about. If the whole issue comes down to the S-corp and he doesn't sign the bill, then the fact the gas line, the legislation isn't going forward is on him. It's not on the legislature. It's on him.
Yeah, the hot potato is the hand grenade is in his lap. He's either got to get rid of it or hold on to it, and I don't think he's going to hold on to it. Because as Brian says, what are they going to do if he doesn't veto? Not reelect him? I mean, that's the thing, right? Right?
I mean, yeah. I mean, the people who are worked up about the S-corp provision are people who either are making up this argument that, it'll apply to all the S-corps. No, it won't. just like the C-corp has a division between the way we tax petroleum companies and the way we tax everybody else. It's a C-corp. The S-corp provision will have a way that we tax petroleum companies, and everybody else will still be off. I mean, they'll still be off in whatever they're doing with S-corps. The Alaska Supreme Court has long since recognized you can tax petroleum companies different than the way you tax everybody else. And so, no, it's not going to apply to everybody else. And so let's forget that. It's going to affect Hillcorp. They're not going to operate in the state anymore. Well, Conoco pays it. And Conoco's expanding. Santos, Repsol, they pay it. They're expanding. Exxon's still here. They pay it. So I don't get this thing about Hillcorp. Is Hillcorp such a snowflake that they can't operate in the same way Conoco, Repsol, and Santos does? Are they so special?
Even the way that they're already doing that in other states, just not here, right?
Right.
So
right. Are they so special that they can't? That's not right. I mean, they're hard-nosed businessmen. Yes, they don't want to pay. They don't want to pay taxes. But if they pay taxes, like Conoco, like Repsol, like Santos, like they do in other states, if they have to pay taxes, they'll pay taxes and they'll keep on going. I mean, so that's not. It's just all these arguments that people up about. Well, we need to study it more. We need to have more hearings on it. We need to do more now. I've had it. I mean, I had it in the 1980s when the congressman, after I figured out the way the congressman had tricked me, and my clients, I've had it the way that everybody is going on about this issue in op-eds and everything else about we need to study it more. No, you don't. It's clear. These guys aren't paying taxes at Conoco, Repsol, Santos, and they're paying in other states. It's very clear. Let's apply the tax to them and get on with our lives. Let's stop screwing around with the gas line bill, trying to figure out how we can delay the S-corp provision.
All right, Brad. So what are you watching this week? 2 minutes. What are you watching this week here as we wrap things up?
I'm watching the Strait of Hormuz, which is, sort of like this ongoing comedy show or something.
Yeah, I know.
And it's flipping. I mean, if you look at the ANS oil price as reported by the tax department daily, it's flipping the ANS oil price all over the place.
Yeah, all over the place.
I mean, the ANS oil price, for those who don't watch this daily like I do or hourly, the ANS oil price this past week has gone below the WTI price, which is just almost unheard of. And what's going on was all these ships, all the Gulf Coast, all the Persian Gulf Coast ships got bottled up when the Strait of Hormuz got closed. And then when the Strait of Hormuz opened, they all ran like the wind. And what's happening to ANS is that all those the pent up ships are hitting the West Coast, driving the price of ANS down. Driving the price of West Coast oil down and driving the price of ANS down, even so far as to drive it under WTI. And now that we're going to close the Hormuz again, I'm sure the price is going to pop back up higher than Brent again. So it's just what I'm watching is just these gyrations that we're going through.
$129 in April, down to $71 this last week, and now it's on its way back up again. I mean, it's just like a yo-yo. I mean, at this point. I don't know what's going to happen, but I know that they're going to spend it all. Whatever it is, they're going to spend it all and then some. It's going to be amazing to watch. All right, Brad. Well, thank you so much for coming on board and being with us. I appreciate it. 1.9 billion. I got the note. It's right here in front of me. So, all right, Brad. Thanks so much, my friend.
Michael, as always, thanks for having me. Well, that's a wrap for another week's edition of the weekly top 3 from Alaskans for Sustainable Budgets. Thank you again for joining us. Remember that you can find past episodes on our YouTube, SoundCloud, Spotify, and Substack pages, and keep track of us during the week on Facebook and Twitter. This has been Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. We look forward to you joining us again next week for the next edition of the weekly top 3.